thank you for waiting. They're here, so we'll start soon. Thank you. Thank you all for coming. Welcome to our annual meetings in Marrakesh. My name is Wafa Amr, Communications Advisor in the Middle East and Central Asia Department. On the occasion of the World Bank IMF annual meetings return to the African continent after 50 years, specifically to Marrakesh, Morocco, the African and Middle East and Central Asia departments have prepared a special issue on Africa, which discusses economic developments for the entire continent. This press briefing launches the special issue after the conclusion of the African Caucus meeting, which just took place. As the Middle East and Africa regional press briefings are scheduled for later in the week, the Africa press briefing, this one, will focus on regional issues. Country-specific issues, inquiries will, you can ask them at those regional press briefings. So I'd like to introduce Abebe Amro Selassie, Director of the Africa Department, and Jihad Azur, Director of the Middle East Department. They will summarize the Africa special issue report, and then we'll take your questions. We do have interpretation in Arabic and French. So please, Abebe.
Thank you so much. Good afternoon, everybody. Apologies for starting the briefing a bit late, but Jihad and I are coming from really very productive discussion of African ministers and in the context of the African Caucus, which just concluded a couple of minutes ago. We are so excited to be back on the African continent for the 2023 annual meetings. The last time we were on the continent was some 50 years ago in Nairobi, Kenya. As was just said, to mark this occasion, we have prepared a note that covers the entire continent, titled Africa in Pursuit of Stronger Growth and Resilience.
Thank you very much. I would like again to seize this opportunity to confirm that those annual meetings are an important moment. It's not only a moment where we commemorate the last 50 years or the fact that we are coming 50 years into the region. I think we are looking forward in those annual meetings in order to see how we together, both North Africa and Sub-Saharan Africa countries, will move forward on achieving the aspirations of our populations.
After 4 years of crisis, including the global pandemic, there are tentative signs that the outlook in many countries in Africa is improving. And growth in the African continent is set to strengthen from 3.2% in 2023 to 3.8% in 2024. Crucially, rising private investment and consumption are expected to lift growth in 2024 for more than 3/4 of the region's economies. Of course, the economies that make up the African continent are vastly diverse. In Sub-Saharan Africa, growth for non-resource intensive economies is expected to average 5.9% in 2024, whereas in North Africa, growth in non-resource economies is forecast to be relatively subdued, slowing from 3.7% this year to 3.5% in 2024. Some good news is that overall inflation for the continent peaked in December 2022 at 10% before dropping to about 7.25% by July. Still, inflation remains too high in many countries, adding to the cost of living challenges facing the most vulnerable. More than 158 million people on the continent, 13% of the population, are acutely food insecure.
Indeed, it's too far early to celebrate. Why? Because daunting challenges remain. Of course, some countries will do better than others, but too many African countries are expected to continue struggling to generate sustainable, inclusive, and job-rich growth that is needed to recover lost ground or to keep pace with the continent's growing population. The continent's future resilience and longer-term prosperity depends on often difficult policy reforms. Moreover, while public debt levels are declining, they remain too high, around 65% of GDP in 2023. Debt service obligations have ballooned for both low and middle-income countries in Africa. Meeting these obligations crowds out critical spending on health, infrastructure, and education.
Education, particularly for girls, is vital, as the continent is home to the world's youngest and fastest growing population, who will soon join the global workforce. But to provide job entrants with new opportunities, there needs to be accelerated diversification. A pivot is needed from government-led growth to private sector innovation and investment in digitalization, widened access to the internet, and green technologies. In this context of continued shocks and disasters, Africa's policymakers need to prioritize efforts to boost resilience by ensuring macroeconomic stability and accelerating structural reforms to foster stronger, more inclusive growth.
The IMF is also stepping up. Between 2020 and today, the fund has provided about $80 billion through programs, emergency financing, and SDR allocation. 6 countries have also had arrangements approved under the newly launched Resilience and Sustainability Facility, including most recently for Morocco. With its young and vibrant population, the African continent has huge potential. Now it's the time for Africa and the international community to come together and help the continent make greater progress in its pursuit of stronger growth and resilience. Thank you very much. Wafa?
Thank you very much. We can take your questions now. Okay. Thank you very much. We'll start with your questions. Please introduce yourselves and the media organization you work for. And as I said, we do have regional press briefings where you can ask your country questions there. Gentlemen over there, please. The microphone is behind you.
Thank you very much. Babajide Komolafe is my name. I work for Vanguard newspaper in Nigeria. When I read the Africa special issue, you listed about 4 measures that has to be implemented. One of them has to do with inflation. In fact, in the report you emphasized a lot about inflation. And you said that in countries where the inflation rate is still very high, that further tightening might be warranted. Does that apply to countries like that has inflation, interest rate have been hiked to almost 20%? For example, in Nigeria, we already have interest rate hiked by over 7%, from about 11.5 to 18.75%. Yes, inflation rate is still rising, hitting 25.8 in August. So does that recommendation applies to countries that have already tightened and the populace is already complaining about a high interest rate? Thank you.
I will, as said earlier, I'll defer questions on Nigeria to next week. But in general, of course, where inflation is high and continues to accelerate, that's a sign that monetary policy conditions are more accommodative than they are tighter and this in a direction that brings inflation down. And the reason to tighten monetary policy, the reason to tighten inflation really has a lot to do also with the distributional effects that high inflation has. There is nothing that erodes the standards of living, that erodes the value of money, but for the poor, for the vulnerable in particular, more than inflation. Okay, it's often the richer segments of society that are able to put money in bank accounts that can shield themselves from the effects of inflation, and it's the poor people that suffer from high inflation. So fighting inflation is generally very, very pro-poor. It helps the poorest in society. So that's why we advocate for it, getting inflation under control, beyond all the other benefits that, of course, low inflation has in terms of fostering better economic activity.
Yes, please, lady.
Hi, Rachel Savage from Reuters. Thank you, everybody. So the G24 group of countries earlier today called for less stringent resilience and sustainability trust criteria to open it up to more countries, plus more funding for the poverty reduction and growth trust. Do the two of you support these? And if, with the latter, more funding for the PRGT, how much would you like to see it enhanced by? And secondly, and forgive me, the data I have here is for Sub-Saharan Africa, but the IMF outstanding loans to Sub-Saharan Africa is about $38 billion compared to $44 billion for Argentina. Perhaps if you add in North Africa, it would be about the same. How does the IMF justify this? Thank you.
So, Jihad, you want to start with the RST question, PRGT?
I think we share this aim to increase the level of support to low-income countries by replenishing and increasing the size of the PRGT. Part of it is also by mobilizing additional grants. The managing director of the fund will announce certain number of news related to that. On the RST, I would reflect on the cases we have in MCD, and I'm sure Abe will give additional information on the experience we have in sub-Saharan Africa. This is definitely something new for the fund. Then the fund has recognized the importance of climate that is macro-critical, and the fund is, through this instrument, exploring new ways of supporting countries. Those programs should be also measured, I would say, shouldn't be only measured by the size, but their ability to mobilize additional assistance, provide a framework, and also help countries into long-term transformation. Therefore, I think it's very important to understand the purpose of those programs, the aim to use those programs for a transformation in those economies. On the third one, I wouldn't measure the support of the fund to countries by the size of the program finance. A, because what the fund provides is not only financing. It provides a huge set of technical assistance to help countries implement reforms. Through policy dialogues, it provides a lot of opportunities for countries to improve their policy framework. And financing, it has to be also something that would help those countries accelerate those reforms. As you know, this is the main purpose of the fund intervention. Abi?
Thank you so much, Jihan. So, I mean, on RST eligibility, I would just add that, you know, there's a perception, one, that RST is only eligible, you know, RST countries, more linearly, that only low-income countries are eligible for the RST. This is not the case. Many middle-income countries are, including, of course, Morocco, that just received a disbursement, that will receive a disbursement under the RST. So, you know, middle-income countries are, as well, the countries that are most vulnerable. And here there is some tension, you know, between making the money available for, you know, those countries that are most vulnerable and, you know, increasing eligibility to a bigger group of countries. Then you, of course, are going to be helping countries that are most vulnerable a bit less. So there's a given amount of resource, and the question is, you know, who to make it available to. So we're trying to strike a balance in terms of the eligibility criteria. If the membership so asks us to change them, of course we will. But again, that tension is what led to the compromise. Second, on the point about you know, IMF support for sub-Saharan African countries, I mean, I think, you know, more generally for the African continent, in the meeting that we're just coming out of, you know, over the last 3 years, since March 2020, when the pandemic broke out, we have provided financing to the tune of $80 billion to the African continent, $80 billion. I think this, you know, many times more the financing that we have provided historically. And second, it came, I think, at the right time, when the region was being shut out of capital markets, when the region did not have any alternative to financing, including internally, as, you know, revenues collapsed, as economies were shut down. So I think we in terms of stepping up to support the region, I think, you know, I think it's a historic thing that we've done, and very proud of it. And of course, going forward also, you know, as long as alternative financing remains scarce, stand ready to support countries.
Yes, of course.
On the RST, we are in a new instrument that is evolving. The latest program the board of the fund has approved introduced new component, which is, in the case of Morocco, is how to increase resilience, how to increase capacity for countries to be prepared for any shock. Therefore, I think it's very innovative instrument that will evolve, of course, with new cases, and also is an instrument that has the flexibility to cater for different type of climate issues. The last point that also I would like to highlight, that many countries in the region are in fragile situation, and the fund has developed recently, 2 years ago, a new strategy that addresses the issues of those countries, the specific issues that those countries have. It's a combination of different type of interventions, whereby the fund, in fact, will mobilize different avenues of interaction with countries in order to address issues of fragility or to help countries who are in conflict. And in few months, for example, we would look forward, for example, for a country like Somalia to reach the completion point of the debt relief, which is a journey that took Somalia more than 10 years to get there.
Thank you. Jihad, any more questions? Yes, the gentleman in the back.
Hello, my name is Godfrey Muchizgo. I work for CNBC Africa. I wanted to ask about your Nigeria numbers. Do they capture the impact of the reforms that we saw being introduced by the new administration? And I then also wanted to find out your thoughts on those reforms and whether they go far enough.
I think we said country-specific questions Friday, yeah? So I will address that Friday, please. Thank you.
Any further questions on the region? Yes, the gentleman in the front, and then the gentleman behind him.
My name is Edward Nyakun, Ghana Broadcasting Corporation. We're seeing Israel and Hamas conflict raging now. How does that play out on the continent's drive to decelerate inflation? Because we're seeing oil prices hiking at the moment about $89 per barrel. Thank you.
Honestly, I think it's of course heart-wrenching to see the conflict, all these people dying, and we really have not done any work on this. It's too early to tell, and really cannot answer much here.
The gentleman in the back, please, in the second gentleman. Yes. Can you please give him another microphone?
Oh, sorry. Okay. Thank you. My name is Echo. I report for Bloomberg. Inclusive of your 80 billion support to African economies are two vulnerable nations, namely Zambia and Ghana, who have to finish a form of a debt restructuring before they can unlock some of this support you are giving to them. Are you aware if they are meeting the official creditors this week? And do you think that any further delays would undermine the effectiveness of the common framework? Thank you.
So, yes, those two countries are part of the 80 billion, and they have received financing. The financing has not stopped. There have been important milestones in the debt restructuring process that both countries have done, and they have received financing as we've done those. Those milestones have been reached with some delay, unfortunately, but they have received the financing. And honestly, whether they are holding discussions with the creditors, you're going to have to ask them. I mean, these discussions are between creditors and the countries. Our task is to support countries in preparing the macroeconomic frameworks, the debt sustainability analysis underpinning that. We work with the countries to prepare those, and we try and make sure that those frameworks strike a balance between, and make sure that the countries are not in a position to have to pay debt that is not going to be payable, without undue austerity. So discussions between creditors and debtors are for them. Thanks.
So please ask regional questions, not country questions. You have a regional question? Yeah.
Again, let's discuss country-specific Friday because.
Can I? Okay. Hi, Raman Yang here, also from Bloomberg. It's a regional question, I promise. Well, two of them anyway. So the G24 briefing, I want to go back to that briefly at the moment, because one of the things that the grouping called for was, in part, debt cancellation for the poorest and the most vulnerable countries. And you must have seen that in the statement and the communique they put out a little earlier. Is that a position that the fund supports, and if so, on what criteria? Because as you've mentioned, and we've heard in the last couple of days, climate change is battering a lot of these economies, it's decimating food security, it's making them quite vulnerable. So on that basis, would the fund support debt cancellation, and if so, on what criteria? Second question, we've seen arguments leading up to this meeting around super seniority, coming up in questions around debt treatment. The basic gist of that argument is that, if bilateral creditors and commercial creditors have to take some pain, why shouldn't the World Bank, why shouldn't the IMF also be taking a bit of pain? Has that debate gone away? How is it being handled at the Sovereign Creditors Roundtable?
Jihad is leaving the difficult questions to me. No. I will do the first one and ask Jihad to do maybe the second one. On debt cancellation, this is what worries me is that there is this view that there is a simple magic wand that you can wave that will get rid of debt or solve these very, very difficult challenges that our countries face. So who's going to cancel the debt? The creditors, presumably, right? 50% of the debt in the region, in sub-Saharan Africa, is, for example, domestic debt. How do you get rid of domestic debt? Okay. So I think we have to be really careful when we're talking about debt cancellations. Again, I think the principle has to be country by country. Okay. The creditor base in each country is now so complex than it has ever been, and debt sustainability also has to be assessed on a country-by-country basis because the economic trajectories, the variables that impact their sustainability differ from country to country, and that's why we put so much store in the country-specific dialogue. The position varies tremendously, and if and when the numbers suggest that there is a debt sustainability challenge, that's when you want to discuss debt restructuring issues, and that's when you enter, those kind of discussions. So I'm not sure there is a blanket debt cancellation solution out there. Hence, I think, this country-by-country focus, going through the numbers and then trying to address it, I think is what is needed. Thanks.
Thank you. I may repeat some of the messages. But let me start first. Yes, the debt is an important issue, and it's a hurting issue, and this is why. Since 2010, at the outbreak of the COVID crisis, we have started with certain specific measures in order to reduce the burden on especially low-income countries in terms of debt service and work with the international community, the G20, on a framework to address debt issues. Two, yes, the issue of responsiveness has to be focused on the type of challenge that we are facing. When we had last year food security issue, we put immediately a new program to address that. Therefore, I think it's very important to recognize the nature of the challenge and to see how we as an international community, and in particular we as a fund, we could play a direct role and a catalytic role. On the debt, there are a multitude of stakeholders. There are the international institutions, there are bilaterals. In the bilaterals, you have one framework, which is the Paris Club, but also you have other countries who are outside the Paris Club. The local market is becoming one of the major holder of the debt. And any debt operation has to take into consideration its repercussions on the stability of the financial system, but also more importantly on the taxpayers of this country. Therefore, I think it's a complex issue. We and our sister institution, the World Bank, we are actively working together with the international community in order to see how we address those issues. When we have that specific cases, like I'm repeating the case of Somalia, the fund has worked years with the Somalian authorities and the international community to reach a debt relief situation. Therefore, again, I think one has to recognize that this is an evolving issue. There is a new issue that also we are recognizing that debt service is going up with the increase in interest rate. And this is something that we are internally reflecting on, how we could address these emerging issues. Therefore, I think, again, we recognize the challenge. It's an important issue. There is no one magic bullet that will address all the problems that countries are facing, but it's one of our main commitments to help especially those countries. And this is why we are mobilizing through PRGT resources that are subsidized in order to help countries who face this issue of high debt and high debt service.
Thank you. We have time for one more question. So, yes, please. Here.
Thank you very much. My name is Shu Takaoka, working for GG Plus, Japanese news agency. I think the major, one of the major agenda in Marrakesh is to mobilize private sector's money for further development. And how should you encourage private sector to take part in the development in Africa? And what are your tips at that moment? Thank you.
Thank you.
So, I think there are two ways in which the private sector can, two broad ways in which the private sector can support growth and activity in Africa. I mean, one is, of course, by providing resources to governments, for example, buying government bonds and the like. But what we are increasingly seeing is in many countries, debt vulnerabilities having gone up. So I'm not sure that channel is going to be as helpful as in the past. And as we note in the report, what's really needed now is less government expenditure-led growth and more private sector-led growth. And I can tell you that the investment opportunities on the continent are just tremendous, tremendous. In many cases, the business environment can be a constraint, but for those that brave that, I think the opportunities here are tremendous. And I think African governments, African countries are doing their utmost to improve economic conditions, to cut and streamline, the constraints that are holding back investment. And so that's the channel through which we work with our members to attract private investment. Jihad, you?
Yes, thank you very much, Abe. I would like to add a few points here. I think, and maybe I will focus more on North African countries. In our outlook, and I would invite you also to come to the launch of our regional economic outlook, we have one chapter that focuses on the importance of structural reforms. Improving access to finance, improving access to technology, addressing the issue of governance are strong contributor to growth. Therefore, for those, you need the private sector and you need private financing. To trade, we have, together with the African department, we did a study on the potential for trade. Trade requires regulations to be adjusted, infrastructure in terms of logistics, and also the private sector to invest. And therefore, there are several areas and platforms where we believe that the role of the private sector will be determinant in the design and also of the future of the economies of the region and the growth. If you invest $50 billion in technology in Africa, you will allow every African citizen, every startup in Africa to have access to internet. One of the main issues that we discovered during COVID, that there is a huge divide because of access to technology. Therefore, yes, the private sector is at the center of the model for growth, including when it comes to climate. Our partnership with various institutions also revolves around that. Part of the purpose of our strategy in terms of climate finance revolves around that. And therefore, in our programs and the way we design the RST programs, we look forward, or we try to emphasize the importance of providing more private sector financing for climate transformation. Therefore, the potential is big. And we recognize that there are several levers that one has to activate in order to increase the role of the private sector in financing the development in Africa.
Thank you very much. Thank you, Jihad. Thank you, Abe. And thank you all for joining. I look forward to seeing you in the regional press briefings on Thursday for MENA and on Friday, Africa. Thank you again.